interest rates you will see in 2024 housing market, car market, credit cards. The interest rates that will apply in 2024 for mortgages, auto loans, credit cards, and savings accounts are the topic of today's video. As you can see, this will have a significant effect on the real estate market, the automobile market for us as consumers, and the economy overall. The rate of inflation spiked, and to fight inflation, the Federal Reserve has been raising interest rates since March of 2022. The Federal Reserve has raised interest rates 11 times, and the Fed funds interest rate is currently at 5.5%. So the rate of inflation has slowed down, and the Federal Reserve has signaled that they will cut interest rates 3 times in 2024. This was written in their Summary of Economic Projections. The expectation is that the federal funds interest rate will decrease from what it's currently at, from 5.5% to 4.75%. Okay, so let me tell you what this is going to mean. The impact it's going to have on interest rates for mortgages, for auto loans, interest rates on credit cards, as well as savings accounts. But first, I have to give you a quick summary of the Fed funds interest rate because everything is going to be based on this. So, the financial institutions have to keep a certain amount of money on hand. For example, if you deposit $11,000 at your bank, what's the bank going to do with that money? They're going to take your money and they're going to pay you some interest, but they're going to take the majority of your money and they're going to lend it out. They're going to pay you, let's just say, 4% interest, but they're going to take your money, lend it out to someone else, and charge them 7% making money off the difference. But they're not going to lend out all of your money. They have to have some cash on hand in reserves, which is required by federal law. But there will be times when the banks or the financial institutions will not have enough money on hand, and in that type of situation, they have to borrow money from another institution. Essentially, they need to borrow money short-term, and the interest rate that's charged between the banks in the lending system is determined by the Federal Reserve. So, that is the Fed funds interest rate. If the federal funds interest rate goes up, then we can expect the interest rates on most products in the economy will go up as well. Here's a chart of the federal funds interest rate over the past 50-plus years. In 1981, the effective Fed funds rate reached 20%, and at that time, the interest rates on the 30-year fixed mortgage hit 18.6%. And as you can see here, during this period, the Fed funds interest rate was at 0.25%, so close to zero. And during this time, the interest rate on the 30-year fixed mortgage was under 3%. So that's the range of the federal funds interest rates over the past 50-plus years. In 2024, we're not going to go back to close to 0%, but then again, we're not going to go back to near 20% either. Again, the expectation is that we're going to be at 4.75% next year. So here are the interest rates that you can expect, and we're going to start with mortgages. The mortgage interest rates on the 30-year fixed are correlated with a 10-year Treasury yield, and the Fed funds interest rate will impact the 10-year yield. Okay, so I just want to tell you this right off the bat. In 2024, we're not going to see the mortgage interest rates going to 3% or sub 3%. It's just not going to happen. For that to happen again, you need the federal funds interest rate to go back to 0.25%, and again, we're not going to be even close to there. Okay, so back in October, mortgage interest rates were at 8%. Right now, they're about 7.2%. Now I want to tell you where mortgage interest rates are going. So, I'll take you back to 2001 when the federal funds interest rate was at 4.75%, and at that time, mortgage interest rates were in the 6% range. In 2007, when the federal funds interest rate was at 4.75%, mortgage interest rates were also in the 6% range. So, I want you to keep in mind that it's not going to be a perfect correlation between mortgage interest rates and the Fed funds interest rate. Of course, there are going to be fluctuations, but realistically speaking, you can expect mortgage interest rates to be in the 5% to 6% range in 2024. Of course, that's better than the 7.2% where it's at right now, but it's not as good as 3% or below that we've previously seen. However, I want you to keep in mind that I'm talking about 2024 because if I had to guess, then I would expect there to be more interest rate cuts after this year as well. So I'm talking about 2025. So if you're hoping for lower interest rates, lower than 5% lower than 6%, then that might happen in 2025 or after. But I'm just saying it's unlikely to happen in 2024. And I know this is important because it's not just for people that are looking to buy a home, but it's for people that already bought a home that have 5%, 6%, 7%, 8% interest rates that are looking to refinance. But I just want you to be realistic with your expectations. Now I want to tell you what you can expect regarding interest rates on credit cards. So, right now, the average credit card rate is at a record high of 21%. But I have to tell you this, I have to show you this so that you don't get disappointed. Even if the federal funds interest rate falls close to 0%, you will not see a big drop in the interest rates on credit cards. So, I want you to look at this. This is a 5-year chart. The purple line is the federal funds interest rates, and the blue line is the average interest rates on credit cards. Even when the federal funds interest rate was close to 0%, the interest rates on credit cards were above 14%. Of course, that's much better than today's 21%, but still, 14% is the bottom of the range. That's because financial institutions, they want to charge an arm and a leg and make their money. So right now, we're at 21%. That's the interest rates that credit cards are charging. If the federal funds rate falls to what we're expecting it to fall to next year, then we can expect credit cards to charge 18% to 19%. So it's a little bit better than 21%, but not by much. If you are in credit card debt, then you should check out my other video about how to get out of credit card debt fast. A lot of people have found it very useful. Now let's talk about savings accounts. If you didn't realize, the bigger banks, I'm talking about JP Morgan, Wells Fargo, Bank of America, they pay you close to nothing. You put money into their savings accounts and they pay you like basically zero. So, the smaller banks, they will pay you higher interest rates. For example, I personally have a Bank of America account, which is legitimate. I am aware that there are other banks out there, but this video is not sponsored by Bank of America. However, Bank of America currently pays 4.35% on your savings account. I know there are other financial institutions that pay similar rates or higher than that. I have seen advertisements, you probably have too, about 5% or better. However, when the Federal Reserve starts cutting interest rates, the interest rates on savings accounts will go down as well. The big banks, you're probably not even going to notice a difference because they pay close to nothing. But they'll actually cut rates even further, the interest rates that they pay. The institutions that pay 4% to 5% will most likely continue to pay 4% to 5% in early 2024. But the interest rates are expected to decline from what they pay you to 3% to 4% in the second half of next year. Now let's talk about auto loans, because there's a lot of auto loans out there. This is a 12-year chart, and look at how auto loans continue to climb higher and higher. It's pretty wild. The Federal Reserve says that Americans owe about $1.6 trillion in auto loan debt. This is about 9% of total American consumer debts. And just so you know, Americans in their 30S and their 40S take out the biggest auto loans. Regarding auto loan interest rates, the average rate for a 5-year new automobile loan is 7.7%. I'm going to tell you two things. So, the first thing is that you have the federal funds interest rates, and then you have the interest rates on the auto loans. So we're trying to predict this based on this, but this is going to be the hardest to predict. It's going to be the most complex because the correlation between the two is not going to be as strong. Now, with that being said, and keeping that in mind, the second thing that I do want to say is that even if the federal funds interest rate falls from 5.5% to 4.75%, that's not going to result in 0% financing again for auto loans. Some of you may remember